How do price gaps make stop losses ineffective? Imagine waking up to find your stock has suddenly jumped or dropped significantly overnight. That's what a price gap is, when the opening price is way higher or lower than the previous close. These gaps happen often in stock and options markets because of news released after hours, earnings reports, or big economic events. Now, if you have a stop-loss order set to protect your investment, you might think it will limit your losses. But in reality, gaps can make these orders less reliable. Here's why. When a gap occurs, the market price can jump past your stop-loss level without any trades happening at that exact price. For example, if you set a stop-loss at $50 on a stock but overnight it gaps down to $45, your order will execute near $45. That means you lose more money than you planned because the order didn't trigger exactly at $50. Instead, it filled at the next available price, which can be much worse. Gaps that happen outside regular trading hours are especially tricky. Since markets are closed during nights and weekends, any news or events can cause prices to jump when trading resumes. Your stop loss can't protect you during these times because it only works during market hours. So, if a big event causes a large gap, your loss could be much bigger than expected. Then there are sudden drops during trading sessions, called flash crashes. These can happen in seconds and cause prices to plummet. Stop-loss orders might trigger at very low prices during these crashes, leading to bigger losses. Also, in volatile markets, stop losses can go off repeatedly because of quick swings, making you exit positions unnecessarily. This can cut into your profits and increase trading costs. From a risk management point of view, relying only on stop-loss orders isn't enough. You might want to set wider stop-loss levels to avoid getting stopped out by normal volatility or gaps. But that also means risking more capital. It's smart to combine stop losses with other strategies, like options hedging. For example, buying protective puts can limit your downside without depending solely on stop-loss orders. Also, keeping an eye on news and market conditions helps you adjust your risk controls before a big gap happens. In short, price gaps can cause your stop-loss orders to execute at worse prices than you expected. This exposes you to larger losses and makes it harder to control risk precisely. That's why it's best to see stop losses as part of a bigger risk management plan, not the only tool. Being aware of how gaps work helps you plan better and protect your capital more effectively.